Welcome to the Leaders Academy podcast. Today's episode, Liquidity Under Pressure, Rethinking Cash Management Strategy for CFOs in 2026. Liquidity is supposed to be the boring part of finance, until it isn't. What's actually breaking down for CFOs right now in 2026?
The assumption that broke everything is this idea that cash sitting in operating accounts is safe. With rate volatility still running hot and working capital cycles compressing across manufacturing and retail, companies are getting squeezed from both ends: higher cost of short-term borrowing and slower conversion of receivables. We're seeing DSO creep back above 50 days at mid-market industrials who thought they'd solve this.
So the days of parking cash in a single operating account and calling it treasury strategy are genuinely over?
Completely over. The CFOs who are winning right now are running what I'd call a tiered liquidity architecture: operational cash for 30-day needs, a tactical reserve in short-duration money market instruments yielding north of 4.5%, and a strategic buffer in T-bills or overnight repo. Unilever publicly restructured along these lines in late 2025 and reduced idle cash drag by roughly 80 basis points across their European entities.
You mentioned short duration yields above 4.5%. Is that accessible to companies below the Fortune 500 tier? Or is this still a large cap privilege?
It's genuinely accessible now, and that's one of the structural shifts worth highlighting. Platforms like Kyriba and Travada have democratized real-time cash visibility for mid-market firms, and I should flag that both have published data supporting this, so take their figures with appropriate context. But the operational reality is that a $300 million revenue business can now see consolidated global cash positions in near real time and execute sweeps automatically. That wasn't practical 5 years ago.
What about FX exposure? For CFOs running multi-currency operations, the hedging calculus must be brutal right now.
It is. But the mistake many CFOs are making is overhedging transactional exposure while leaving balance sheet translation risk completely unmanaged. We had a client in precision engineering, European revenues, USD-denominated debt, who was perfectly hedged on their invoices, but took a 12% hit on their net asset translation in Q1 2026 because sterling moved sharply. The lesson is that your hedging program needs to match your actual risk inventory, not just your AP and AR flows.
Where does AI fit into this? Is it genuinely changing treasury operations or still mostly vendor hype?
It's real in two specific areas: anomaly detection and cash flow forecasting, where machine learning is materially reducing forecast error. BlackRock's Aladdin Treasury module cut forecast variance by 18% for one large logistics client, according to their own published case study. And in covenant monitoring, where AI flags potential breaches 3 to 4 weeks earlier than manual review. Outside those applications, I'd treat most claims skeptically.
Final question. One thing a CFO should do this week, not this quarter.
Pull your actual cash concentration report, identify every account earning below 2%, and set a 30-day deadline to either sweep it into yield-bearing instruments or close the account. That single action has recovered meaningful basis points for every treasury I've reviewed in 2026.
To go further, Leaders Academy offers strategic training programs, diagnostic tools, and an executive self-assessment designed for CMOs, CDOs, CFOs, and leaders aiming for board-level performance. Explore everything at mba-training.com. Thank you for listening to the Leaders Academy podcast. See you tomorrow for another episode.